All right. Hi, everybody. This is Dave Shotwell, and here with my partner Nick Nada for our first ever video market update. How you doing, Nick?
I'm doing well. It's a Friday.
It's a Friday. It is. It's a Friday in the summer, so we'll try not to talk too fast and just plow our way through this. Um, Speaking of doing well, we're sitting here at the end of the second quarter in the market, which looked nothing like the first quarter in the market. Wild and crazy. Um, with all the coronavirus stuff going on, the market is pretty much back to where it was in January.
Yeah. Very, very unusual to have that fast of a drop and then that big of a recovery, which really was what the federal government was trying to have happen for the economy as a whole. The stock market's playing along, the economy not so much. So
No. And at this point, the numbers for second quarter's the economic downturn, came out yesterday, and it was horrible. And the market reacted, but more or less shrugged it off. And
right.
it's just interesting. I guess one point of view is we're always telling clients to take the long view and not focus on the short term and what's going on in the economy, and just remember that the markets follow long-term trends. And it just seems like that rational approach is really kind of what we're seeing in the market.
Yeah, for sure.
Trying to look out past what's obviously a ugly situation, but is really hopefully not permanent. So
yeah, I think a lot of times we forget how strong the economy was before all of this.
Right.
Different than 2008 when the economy was kind of at a different place when the whole subprime crisis hit. So
right. Well, and the issues that caused the problems in 2008 and 2009 were the financial system itself, not just like this. This is more akin to a natural disaster outside of the economy, not necessarily something that was rotten within the economy, where we saw runaway housing prices and runaway borrowing and all of the issues that led to Lehman Brothers and Bear Stearns and AIG and so many people underwater and in fear of defaulting on their mortgage. It's not that this is a good situation, but it also points to the fact that maybe we can get back to normal fairly quickly once the health situation is under control. So
yeah.
I like this chart because it puts the last 5 years on, and you see, we've had some fairly good disruptions in between, but more or less a pretty good straight line march up since early 2016. So
yeah, well, and we were talking about this earlier, Dave, a couple of days ago about Brexit, and that was back when it happened, a big deal, and we were, talking to clients about some things, the potential ramifications of that. And now it's just this little tiny blip on this 4-year chart.
So it's a little
still going on, really, if you think about it.
They still haven't quite
fully exit. So
quite wrapped their heads around it, but yeah, that was a pretty dire couple days there in June of 2016.
Yeah.
Remember, I was in Washington D.C. when that news came, and it's down there. My wife was working there at the time, and I just remember my phone ringing constantly that morning about what was going on. And here we are, not a big deal. So let's switch screens here. I can't remember. I've been using these charts that we get from dimensional funds with these quarterly summaries, and I'm trying to remember another time when every arrow on the screen was green. Usually we see at least something down, but the U.S. stock market plus 22% for second quarter, international stocks 15%, emerging markets 18%, global real estate up 11%, bonds up 3% in aggregate, and global bonds up 1.75%. That's a pretty rare situation. So we won't expect that too many times in our career.
Yeah, exactly.
So not a lot of losers. Of course, within each of those categories, there were some that did better than others, but by and large. And and you've got to take it in perspective with, we had one of the best quarters on record, if not the best, depending on which indices you want to use, in second quarter, but it was following like one of the worst quarters ever. So, and if you look on this chart, they give you the best quarter and the worst quarter for each of these periods. And as you see, at least for international stocks, the worst quarter on record was last quarter, Q1 of this year. So we still still wasn't quite as bad as 2008 for the U.S. stock market, at least using this indicator. So, we like this nice, simple, good news, bad news chart that we steal from SEI. On the good news side, the global economy seemed to bottom out in April. It's been showing signs of sustained growth. Although pre-pandemic levels of activity will not likely be achieved anytime soon. I think we're seeing that. Probable second wave of the virus in the autumn and winter months is not expected to lead to a repeat of the extensive lockdowns that occurred during the initial wave. That one I'm not so sure about. Here in July, we've seen at least a lot of threats from state and local governments about having to backtrack to some of the more extreme shutdowns, depending on where you're at.
It's been interesting. It seems like the states that took it a little bit more seriously are, a little bit better position right now, and I think the same could be said for Europe and what they've been able to do over there and slowly opening up, and which looks good for potentially for Europe and international to weather this second storm a little bit better. And I think that speaks to the importance of diversification. We get a lot of questions about international investing, which has not done as well as U.S. in the really for quite some time.
Yeah.
So this just speaks to everything is cyclical, and we what we don't want to do is make bets on which one's going to do better. We want to kind of have a diversified portfolio because we know that history tends to repeat itself, especially in these cycles, and when international equities do better than U.S. equities. So I think that it would seems to be that we're ripe for a swap of international outperformance in the U.S.
It's got to happen at some point. Yeah, just the way the pendulum swings in the market, you never know when it's going to change, but when it does, you'll be glad you had that international and emerging market exposure for sure. Investors flocked to risk assets during the second quarter, emboldened by monetary and fiscal support provided by governments. The government basically aimed the money cannon at the problem in a way, and it seems to me they learned some lessons from 2008 and 2009, where there was a lot more wrangling and hesitancy to intervene. This time around, they basically just said, yeah, we gotta do this. We'll figure out the details later, but really bold moves on unemployment benefits and just getting some money in the hands of people that were going to need it. And they erred on the side of being too generous instead of not generous enough. So
yeah, and I think a great example of that is the small business loans. If you recall, they did that first wave and it was out within like days. And they were really quick to refund that, which typically doesn't happen in government.
Right,
so
right.
That was a big benefit for sure.
Right. Inflation is not likely to break out of the past decade's benign range, allowing central banks to keep interest rates near record low levels, which is an interesting point, and they don't elaborate on it here, but another guy I think pretty highly of said, because it can be kind of antithetical that the government's pumping all this money into the economy. We would expect inflation. Well, you'd expect inflation if the government was pumping in money on top of money that consumers were already spending. But instead, they're pumping money in on top of augmenting reduced demand, bringing it back to normal instead of putting it on top of normal demand. So
that makes a lot of sense.
Yeah, well, and the other thing I point to with clients on that is, the government can borrow right now at like 2% or less for 10 years. And if I could borrow at 2% or less at 10 years, I would take all the debt somebody would give me at 2%, you know?
Right.
So,
Yeah.
like if we were talking,
Yeah.
if we were talking about instead of the government, we were talking about a client and say they wanted to do, instead of building highways or, or whatever, they wanted to put a new roof on their house, we would take a home equity loan at 2% all day long for 10 years.
Sure.
That would be a good
Well,
way to go.
we've even seen that with mortgage rates and doing some refinance work for clients where it just makes sense to, at 3.5% or 3%, depending on your 15 or 30 year.
Mm-hmm. Mm-hmm. And as far as
so like similar philosophy,
yeah, and interest rates and inflation are as hard to predict as the stock market. And somewhere out there's a former bank CFO who I owe a lunch to, because I bet her that in 2010 we'd see 5% on 1-year CDs by 2015, and we've never ever come close to that since then.
Yeah.
So one of these days she's going to find me, and I'm going to have to make good on that. But
right.
so. And we know much more about the virus now than we did 6 months ago, which helps us make a more refined, targeted approach to managing outbreaks. I'm glad they put that as a good news item. I'm still waiting to see the science follow through on that. But
yeah, very true.
Yeah. On the bad news side, and I think this is very true, until the vaccine is readily available for global distribution, countries will need to depend on a robust system of testing, tracking, isolation, and treatment. We're pretty much at the mercy of COVID-19 until we really have good health data on how to protect people.
Right.
At the end of the day.
And recently, there's been a little bit of good news on that, with some testing going out, but that's a very fast timeline for stuff like that.
Yeah.
And I think we've seen the market react to that a little bit. There's been a couple of days where the market reacted positive to some potential vaccines.
Yes. Yeah. And not so much to the bad news lately. It seems like when I first saw the headlines a few weeks ago, when numbers started ramping up in Texas and Florida, I was like, oh no, here we go again. And the market was kind of blah about it. So, also in the bad news column, stock market valuations do not likely reflect the challenges that lay ahead for many industries. And that's kind of a cryptic way of saying, the damage and the changes to the economy are still to be determined in a way. And the economy is going to look different a few years from now because of this. And we always tell people stock prices track corporate earnings over the long haul and project expected corporate earnings.
That's one of them that we hear quite a bit when it comes to stock market valuations, where we're at. It seems like we've been having this conversation about stock market valuations for a long time, because it seems like things continue to go up and up and up. Historically, I think, we're not at a huge bubble like we were in 2008, but we tend to lean on the higher side of the averages for sure. So,
yeah.
Long term, I think we'll be fine, because I think we're gonna have lots of innovation in terms of how these companies make money and what they're doing, and lots of work from home stuff. The world is changing at a rapid pace right now, so I think that bodes well for long term. But short term, those valuations can potentially be cause for some volatility for sure. Right.
And in that sense, economies evolve all the time, usually from, either a new technology or some kind of outside stimulus like this, but things change, and it doesn't necessarily mean that it's not like every company loses. There's winners and losers. We've seen that as earnings reports have come out. Amazon, UPS announced their second quarter earnings yesterday, and it was their best quarter ever because everybody was shipping it, right? You wouldn't want to own a restaurant stock in second quarter, but owning UPS doesn't sound so bad, right? And so we shift the way we do things, but we don't necessarily see the economy change in terms of its net overall growth.
Right.
So kind of like the old economic textbook example of the buggy whip makers in 1910. You know,
Sure.
all getting replaced by the future General Motors and Fords of the world. But you know, the economy grew leaps and bounds because of the automobile. But if you were a buggy whip factory owner, you were pretty much in trouble.
Yeah. Yeah.
And most countries will likely be saddled with a significant increase in their debt burden. Financially weaker countries in Europe and Latin America could again be at risk. And there's nothing new to that. We've been dealing with worrying about the Greece's and the Ireland's and the Portuguese economies. And
yeah, there's been some interesting recent developments in Europe too, with Europe kind of coming together to bail out some of those weaker countries, which is something that historically has never really happened, especially to this degree. And so a lot of people in Europe believe that this might be a sign of, a new big change for them. So definitely worth keeping an eye on.
Yeah, that's definitely a political change from 2008 and 2009 when Germany and France were ready to leave Greece to their creditors. And there was a lot of talk about will the European Union survive, because you've got one currency covering all these different economies, but if those economies aren't working together to and an analogy somebody gave me at the time was in the United States, we have one currency. Every state has their own economy to a certain point of view. But, when a hurricane hits New Orleans, FEMA rushes in and takes, spending the tax money from Ohio and New York and California to shore up New Orleans. And it would be kind of like what was happening with Greece in 2009 was kind of like if Ohio and California and New York said to New Orleans, sorry, you're on your own for this one, even though it's the American dollar that you're spending, you're not going to borrow on us. And so, since then we've seen Brexit, we've seen a lot of pushback on that quasi-federalist system that they created. And it's like this time around, they learned their lesson. And just last week, it was several $1 trillion of collective aid that they passed to going. So that's interesting. The last point in the bad news column they've got is there could be a reversal in tax policy if there's a wave election in the U.S. favoring the Democrats. I'd buy that to a point that in terms of, yes, there probably will be tax policy changes, but if it was really the kind of tax policy changes that the market was overly worried about, the market is always discounting the news. We tell clients this all the time. The market's looking at what's expected to happen 2-3 years down the road. So if we really had to, in my point of view, is if that was like a huge threat, as soon as those poll numbers started showing that the Republicans were likely to lose the Senate, likely to lose the White House, we'd see the market saying, oh my gosh, then GM is going to pay 35% in federal tax instead of 22%. And we'd start seeing, we'd already be seeing that to a certain degree. To that point, there's only so much you can do within our political system all at one time. It still takes 60 votes to get something through the Senate. We still have rules to prevent one party from running roughshod over the other, for better or for worse sometimes. But let's just say that like huge changes to the U.S. tax code, either corporate or individual, isn't something that keeps me up at night at this point. I would expect, tax rates are really low right now. They're probably lower than they should be. And we should say, thank you, count our blessings, count our money, but expect some of that's gonna change. I mean, it's just but there's a difference between going from, a middle class American at say 22% income taxes, seeing that go back to the 28% or 30% it was a few years ago is different than 40% or some crazy number.
Right, and I think on the corporate side too. I mean, we were, as far as like our competitors from a national standpoint, we were way at the top. I don't know if you have that slide in here or not.
I don't. I was just looking for that. Yeah. The U.S.
Just go ahead.
Yeah, at the old tax rate, 35% headline corporate taxes, we were the worst in the developed world, or the highest in the developed world. and at 22% now we're like right in the middle. So so there's some room either way to still be competitive.
Yeah, even if taxes go up, still to be competitive, which I think is becoming more important as, you know, we see competition among, you know, these companies where they're going to domicile. So
right. And so you'd hope that whichever party's in charge of determining tax code in the near future looks at it not in terms of just raising it to an appropriate level, but also looking at how many companies are going to stick around and pay those rates if they change them, which is what we were seeing for the last 20 years. Companies just packing up and going. So just a slide here on U.S. economic growth over the last, actually going back to 1970, and you just see Q1 2020 going from nice level, you know, constant growth in that cycle of 2.2% down to like -5 overnight.
Yeah. Well, what's crazy is look at how many, you know, the last time we even had a downturn was what, 2014 for a quarter? Is that when that was? Yeah.
And it was just a small downturn.
Right, and since 2008, we really haven't had just those two until this one. So this is something that we had always talked about probably happening. No, nobody knew this was going to be the cause of it.
Right.
But, and I think it speaks a little bit more to the new normal of, you know, we always talk about 2% GDP growth as not being that much, but it's more of a slow and steady than it was back in, you know, the 70s and 80s. So I think that was kind of more of the new normal of that slowing. You don't see those huge jumps, but you don't see those big drops either.
Yeah, and quarter by quarter changes that were extremely big. Yeah. So, and you know, we talk about the stock market responding to the global pandemic. This chart shows the stock market reactions to past events like this, all health related. So SARS, the avian flu, the H1N1 virus, MERS, Ebola, and Zika. And they kind of, you know, with setting them all to zero at the bottom, you see, you know, coming in, you had better markets, and then going out, you see pretty steep recoveries. Whether this one plays out the way the past ones have, it's hard to tell. This is the first one we've had that's really impacted the economy. And I think that's the big difference. You know, all of those, you know, we all remember them to a certain extent, but none of them led to government shutdowns and huge changes outside of Hong Kong and China to a certain degree. So, you know, as Mark Twain was famous for saying, history doesn't repeat, but it often rhymes. Well, you know, I wouldn't expect this chart to look exactly like the past ones, but hopefully it'll at least reflect the overall. So yeah, this one kind of goes with the GDP growth story we were talking about and valuations, with the light blue mountain chart being the earnings per share, how much companies are making versus their stock price, and then the blue line being the S&P 500, and you see that the S&P pretty much follows earnings growth, and then in the long run, that's what really matters. So we kind of see that continuing, but right now, back to what Nick was talking about with valuations, because earnings have dropped and the stock market has come back up, we're at a point where stocks would historically look kind of expensive right now. So the bet that the market is making overall is that those earnings will recover and get right back on track, and that this trend will continue together. So, and then, you know, by contrast, everybody talks about the tech bubble. This is when I started in the business right here. And you can see the stock market was way ahead of where its actual earnings were, because anything that had an internet tinge to it shot up in price. And then it came back down to earth. And it's been a pretty, you know, if you took the average, you know, distance between these two lines over time, it stays fairly steady. So the market lately, actually going back, this chart goes back to 2016, but shows the difference between the S&P 500, which is the largest 500 companies in the country, versus what everybody calls the Fang stocks. So Facebook, Amazon, Apple, Netflix, and Google, um, which is now actually called Alphabet, but it doesn't make for quite as nice
Yeah.
name, so they stick with the old name of Google. But since 2016 through the recent peak in July, just a couple weeks ago in 2020, 271% for those stocks versus the S&P 500 performing a very respectable 55%. But when we look at those on the same chart, they don't look so great, do they?
Right. Yeah. Not in the least.
Yeah. Yeah. So.
And so interesting about the Fang stocks too was the recent earnings release where they all think the estimates were very close to them. So that was obviously helped the market out quite a bit, especially coming off that bad economic data.
Yeah. Yeah. And if you think about what each of those companies does in a way, they play right into the kind of economy we're in right now, where we're sitting at home, we're watching Netflix, we're watching movies on Amazon Prime, we're doing online shopping because we don't want to hang out at Walmart any more than we have to. And, and we're doing it on our iPhones and our iPads and our Macs. And,
Sure.
So it makes sense. So a lot of people look at these charts and they really worry about this. And, back to what you were saying with what's happened in the last couple of weeks, yesterday, the day before yesterday, the CEOs of a few of these companies got called in to testify before Congress because they are just so big and so important now that it's kind of we're kind of in this situation where we're relying on these companies, but are we relying on them too much? And be interesting to see how that plays out here. But
for sure.
From a market standpoint, what we've got to watch is that if these are what's driving the indices, if these start to come back down to match, the overall indexes, where does that put us? And so again, it would have been nice to have been able to just invest in those 5 stocks a few years ago. You could have had the most undiversified portfolio in the world and just done incredibly well. But at some point that comes back around to haunt you.
Yeah, I think that's a great point to talk about diversification and why it's so important. I mean, if you think pre-2015, if you think about these stocks, some of them, were barely getting started. Nobody really knew what they were, and now they're kind of leading the charge. And so, but if we talked, 5 or 10 years ago, there'd be a different slew of 5 or 6 stocks that were kind of leading the charge too. And there's no way to potentially pick out what these stocks are going to be. And so, when their cycles are going to go up or down. And so just the risk in owning those kinds of stocks, and, obviously it's great for the market. It's great for broad diversification. We're getting the growth out of them.
Right.
But we can't pick who those stocks are going to be. And so that's why it's so important to be diversified.
And to that point, say we were having this conversation in 1958. I don't know the exact years, but say the late 50s, early 60s, if we'd had some way to record a video like this, we'd have been talking about RCA, National Cash Register Corporation, IBM maybe, it would have been an entirely different cast of characters, but there still would have been those 5 to 10 companies that were the darlings of the market at the time, and it's always a rotating cast. A client and I.
Go ahead.
No, we were talking about Eastman Kodak yesterday. Her mom gave her some shares of Eastman Kodak in the 60s, and we went back and looked because I couldn't remember the timeline, but they're completely worthless now. But that was a darling of the. And another thing about unpredictability. So if you take Netflix for example. So Netflix started as they were the red box that you got DVDs out of to take home for the weekend, right? And if you think about that,
DVDs.
and that model is completely looks silly in retrospect, but they were able to somehow, adapt themselves to something completely different.
Right.
Which
And
is
continue
great.
to do that with all the pressure that they have
Right,
now with,
right. But how do
Apple
you
coming out
predict
there.
that?
Everybody has a streaming service now, and somehow
Right,
they're still
right.
doing well.
Okay, so another thing that's on everybody's minds right now in terms of like where the market's going, where the economy's going, is the presidential election. And
Yeah.
a lot of people focus on the election and what the election returns might mean for the market returns. And so I thought a little history might help. And so this shows the S&P total returns in election years, and then on the left, and then S&P 500 election years 1 year, or returns 1 year after an election, broken down by party. And the conventional wisdom is that Republican presidential victories are better than Democratic presidential victories for the markets.
Right.
And you can see in election years that is not the case, or hasn't been the case. 14.6% versus 10.4%. But I think it's even more interesting that a year later, after policies become more concrete and the president's worked with Congress, there's almost no difference.
Right.
And we like to think that, or we like to think that it makes a big difference, but the statistics at least don't show that. Now, if you know enough about statistics, you know that there can be outliers that skew things one way or the other. And of course, 2002 and a couple other pretty getting my years mixed up.
Yeah, this one surprised me a lot when we were talking about going through it the other day. I would have guessed complete opposite, and I would have guessed that there would have been some bigger impacts. And it's interesting. I actually listened to I think Freakonomics had a podcast out about how much of the president actually influence, or can they influence, and that brought on a couple different experts, and they were there was some of them that said very little, and some of them said that they could have a big impact, and so. Not really a concrete answer, but it's interesting to think about, how much of an impact really is there. And obviously from a stock market perspective, not really a whole lot.
Yeah. Yeah. Kind of take it another step further. This chart shows non-election years versus presidential election years and midterms. And so in years where there's no elections, the S&P 500 has averaged 15%. But then in years where there is an election, it's 10.5, whether it's a presidential election or a midterm election. And that's pretty interesting. And that just tells me, things are going to be, to me, that speaks to the fact there's probably going to be more volatility, as we go through the fall,
for sure,
both up and down. But at the end of the day, it doesn't mean as much. The chart on the right here is the same set of data, but excludes 2002 and 2008 because those were such bad years that they skew the data. And so when we exclude those, we end up seeing there's really not a lot of difference in election years versus non-election years. So
sure. Well, one thing that we always say too is, the market doesn't like uncertainty. So it kind of bears that out when you know who's in policy, you know what policies are coming out. But when you're unsure of what's going to happen, then it's kind of scary for the market at least.
It's funny, at the time we didn't know how to put it in perspective, but I remember in the fall of 2000 when the election was being contested, the stock market was horrible. And we're waiting for things to be resolved between Bush and Gore and for the Supreme Court to weigh in, and the market was just horrible. And once that was resolved, it steadied out quite a bit. But at the time we were blaming it on the election and didn't realize it was just part of a huge bear market downturn anyway.
Right.
We were hoping once the election was resolved. So, on the topic of what happens in any given year, I thought this was interesting. This shows the S&P 500 index returns going back to 1980 with the blue bar being the actual return for that year, and the red dot being the biggest drop the market sustained during that year.
Right.
And you see, you know, in any of these years, even these really good years, there was definitely a negative time in all of those periods. But it's always,
Right.
you know, a pretty big disparity between the ups and downs. So, in like last year, the S&P 500's return for 2019 was 29%, but during the year we were down 7% at one point.
Right.
You know, and it just kind of brings back home that, you know, if you're going to be in the market and stay in the market and enjoy these good returns, there's going to be times when you're going to want to burn your statement, you know.
Right.
That's just part of it. And
Yeah.
you know,
I think that if you can go back to that one real quick, Dave, I think that one more than anything speaks to, you know, the behavioral, we call it behavioral finance, but it's really just about your ability to take risk and your ability to understand risk. And what I always tell people is, you know, this is kind of that education, right? So if you know that in any given year, if you're 100% invested in the stock market, you could be down 49% one year. But the flip side of that is, you know, chances are, if you look at the number of ups versus down, you're going to have much more positive years than more negative years.
Right.
If you look at the returns of this, on average, you're going to have a much better, you know, you're going to be in a much better place return-wise over the long term. And so, but understanding that, mentally preparing yourself for the fact that pretty much every year, at some point, you're going to have lost money.
Right.
So if you can understand that, you're much more likely to stick it out and hold on to your allocation than if you are not prepared for a 30 or 40% drop in the market. You're going to panic and you're going to make a mistake. And I always tell people make the most mistakes when there's the most chaos going on. So a 30% drop in the market is pretty chaotic if you haven't already prepared yourself for that.
I'm actually gonna skip back to the beginning chart here for just a second on that point, because part of it is, like, when you're sitting here or here, it's almost impossible to look out and say, okay, yeah, but in a matter of time we're going to be back up here. Because when you're standing here looking at your account in the middle of a fight over the trade with China, or as the coronavirus meltdown is going on, it's really, really hard to be optimistic about anything. And the tendency is, we call it recency bias, actually, in behavioral finance. And, you know, the most recent news colors your perception of what's going to come. And it's so easy to forget all of this when what's in your face is trade with China and the market's going down, and it's never going to be the same again. And it's not that it's not that you're it's not that it's not something like character flaw. It's just the way we're wired, you know. It's not that there's anything wrong with feeling that way. It's the way human nature is designed.
Absolutely.
But when we, you know, this slide talks about what happens when you do try to get in. So what this slide talks about is, if you were to jump out of the market after the 20 worst days in the market in any time frame and then miss a certain number of days, what would the effect have been? So if you invested $1,000 in the market and stayed invested, that $1,000 over 25 years would become 4,803. But if you were to jump out and miss the best day following 20 down days, it would only be 4,304. And as those time frames go out, you see, like, if you were to take your money out because things were bad and sit on the sidelines and miss the 40 best days, your money would be less than what you never would make your money back. You'd be 450 out of 1,000. So, you know, when people talk about getting in and out of the market, you've not only got to get out at the right time, like before the damage is done, you got to get in before the good times come back. And, you know, back to that idea of recency bias and understanding, like, how you're going to feel during those times. It's going to be the worst the worst feeling to get back in when you should.
Right. And loss aversion is such a big thing, and it's, for most people, it's more important than gains. But what this chart is clearly telling us is even if you missed the worst 20 days of down and you only missed one day of up, you still wouldn't be ahead.
You still hurt
It's kind
yourself.
of crazy when you think about it. So
Yeah.
the most important thing is making sure you get those up days, and the only way to do that is to stick with it.
Yeah. Which, a lot of times in those situations, the feeling is just to do something, just do something,
Right.
And doing nothing keeps you over here, Yeah, and I like this one too, to kind of go with that, back to the idea of when you're in a bear market, it seems like it's going to go on forever. It has gone on forever, and nobody made any money in between the bear markets. And then you look at this,
Right.
and so this just shows from 0% with the upside and downside of different market cycles. So let's just looking at the last, we had an 11-year bull market. Rest in peace, never forget. But it lasted almost 11 years, and almost 11 years to the day. 401% growth. So you would have doubled your money 3 times during that period, compared to the bear market that preceded it, the financial crisis, one of the worst, in history. And it was down 57% for 1 year in that time.
Yeah.
You really can't compare, but we mentally lose that scale and that difference. And I don't know how many times I've heard people say something to the effect of, well, I lost everything in the financial crisis and I never made it back. Well, if you didn't make it back, there's a reason. You must have, back to the last chart, you were one of those people that was trying to jump in and out, because if you just stayed put, all that damage would have been undone many times.
Well, that's why it's so important from our end when we're putting together investment plans and allocations, that risk tolerance piece of, we got to figure out what you're going to be able to withstand, because if we overshoot and put everything into the market and you don't come back, you won't come back if we have to take your money out. So that's why it's so important that we work and continue to work with creating that asset allocation that matches your risk tolerance and your goals, so that we make sure that you stick with it. I think
for sure.
That behavioral finance piece, that's so important. And when we're connecting that to goals and what's important to you, and a lot of times when we're doing that, we're figuring out, okay, what's the least amount of risk that we can take and still be able to give you the ability to do the things that you want to do, because that's at the end of the day what this is all about.